Hello everyone, this is a Finance and IT Professionals assignment, which will be conducted by me, Bidi Siddhartha Harmono, Mbaji Mwaza, Michael Jury, and Aris Ahmad. In this presentation, we will examine various financial statements and the interpretation of graphs for different criteria. Now we'll take a look at the statement of cash flows. It can be seen from the net cash flows line graph, specifically investing, that there has been a decrease in total cash outflows over the course of 2018 up until 2020. This has led to an increase in total net cash flows over the course of 2018 up until 2019. However, despite of the decrease in total cash outflows from investing, the company still experienced a decrease in total net cash flows in the financial year end of 2020. This is most likely due to an increasing amount of cash flows from financing in 2020, which is most likely due to the company trying to pay off note payables and pay off debt. Moreover, it can be seen that the cash flows from operation for this company has been decreasing at a continuous rate. It can be seen that over the course of the 2018 up until 2020, that there has been a significant decrease in net cash inflows from operations. This is most likely due to a decreasing amount of net income as well as an increasing amount of accounts payable. It can be seen that on the financial year end of 2020 that the beta has a negative cash flow. Thus, it is recommended for a company to bounce back from this negative cash flow in order to maintain a financially stable position. In this slide, we'll be talking about the horizontal analysis of the income statement and the balance sheet. In the first graph, we take a look at the net income bar graph. It can be seen that there has been an increase in overall net income over the course of 2017 up until 2019, in spite of the slight decrease in 2018. However, the company also experienced a significant decrease in the financial year end of 2020 in overall net income. This is most likely due to a significant decrease in total sales as well as gross profit. On the second graph, we'll be talking about the total assets and total liabilities and shareholders' equity. It can be seen over the course of the first 3 years, 2017 up until 2019, that there has been a significant increase in total assets and total liabilities and equity, which is attributed to the increase in total current assets, total current liabilities, and total shareholders' equity. However, they have experienced a slight decrease in the financial year end of 2020. From these two graphs, it can be shown that the company has been very efficient and profitable in terms of decision making. However, due to some external factors and uncontrollable decisions, it can be seen that the company has experienced some downfalls as well. In this slide, we'll be talking about the percentage change of the income statement as well as the balance sheet. In the line graph, it is shown that the orange graph represents the net income. And it can be seen that over the course of 2018 up until 2019, there has been a slight increase in total net income. However, they have experienced a significant decrease in the financial year end of 2020. This can also be reflected on the total assets and liabilities and equities, that there has been an increase over the course of 2018 up until 2019 and a significant decrease in the financial year end of 2020. This can be attributed due to the significant decrease of cash as well as sales. From this graph, it can be said that the company has been very efficient in the financial year end of 2019 and much less efficient in the financial year end of 2020. In this slide, we'll be taking a look at the vertical analysis. In the first graph, it can be seen that the bar graph of the net income has followed a similar trend in accordance based on the previously mentioned horizontal analysis of the net income. It can be seen from the first 3 years from 2017 until 2019 that there has been an increase in overall net income despite of the decrease in 2018. However, they have fallen even further on the financial year end of 2020. This is due to fluctuations of sales. On the second graph, we'll be talking about the balance sheet's percentage change, whereby it can be seen that there has been a significant decrease over the past 3 years on 2017 until 2019 of long-term assets as well as long-term liabilities. This is most likely attributed due to the decrease in accounts depreciation as well as long-term loan. However, on the final year, they have experienced an increase in both long-term assets as well as long-term liabilities. On the other hand, current assets and current liabilities have increased on the past 3 years due to an increase in accounts payable as well as accounts receivable. However, they have also experienced a decrease of current assets and current liabilities on the financial year end of 2020. It can be seen from this graph that the current assets as well as long-term assets have a negative relationship. In this slide, we'll be taking a look at the financial ratios for a company beta. After taking a quick look of each graph, it can be seen that the company beta has performed effectively and efficiently in financial year end of 2019. However, they have experienced a major downfall in the following year due to a decreasing amount of debt ratio, profit margin, as well as earnings per share. A decreasing amount of debt ratio means that there is an increasing amount of total debts in comparison into total assets. This is also evident by the increasing amount of current ratio, whereby the current liabilities is increasing in comparison into the current assets. From this, it can be seen that the company has started to perform very poorly in the following years. Now, I would like to pass the presentation into Baji.
Thank you, Vidi. I am Baji, and I have aspirations to work in a business management setting while also getting paid to play or coach a sport. I will be talking about capital budgeting, which helps to measure the feasibility of a project, and I will also address time value of money, which relates to compound interest, present values, and future values. To begin, capital budgeting allows us to see the value of investments that a business is considering, and we can break that down further into objective and subjective measures. With objective measures, we can firstly look at the net present value. A project is acceptable if the NPV is above zero due to the fact that it will increase a company's earnings. In the NPV graph, Beta Limited meets that criteria, and since the NPV is greater than zero, the internal rate of return and modified IRR should both be greater than the weighted cost of capital. You can see that the IRR is 20% and the modified IRR is 17%, which are both higher than the WACC of 14%, so this is acceptable. And lastly, the profitability index should be higher than 1. Beta Limited has a PI of 1.12, which also meets the acceptable criteria. Next are the subjective measures. The payback period and discounted payback period both calculate the amount of time needed to recover the investment. The difference being that the discounted version accounts for time value of money, so it would be longer. As you can see, Beta Limited has a payback period of 2.33 years and a discounted payback period of 3.43 years. You would compare this to a benchmark to see if the project is suitable. Lastly, the accounting rate of return is compared to a required rate of return. A project can be accepted if the ARR is greater than the RRR. In this case, the ARR is 16%. Although there are some drawbacks, like not accounting for time value of money, these figures can help to make a decision. Now let's talk about compound interest. Firstly, future value refers to money invested that is impacted by constraints such as interest and time to result in a cumulative amount. This is represented by the upward sloping graph on the left. For example, you can see that if you invested $20,000 at a 5% interest rate over 6 years, the value steadily goes up. This is a positive relationship between the interest rate, time, and future value. So what this means is that if the time and interest rate increases, your future value would also increase. If interest and time decreases, your total future value also decreases, shown by the orange and red lines, which are an interest rate 2% higher and one that is 2% lower. Next, the present value refers to a principal amount that is deposited, borrowed, or invested at the beginning. Think about it like this. If you had a goal to save, a time period, and an interest rate, how much would you need to start saving now? This is seen in the downward graph on the right. With present value, there is a negative relationship between interest, time, and value. When the interest rate and time increases, your present value needed will decrease, and vice versa. When it comes to the aspect of interest, let's look at the graph on the left. You have borrowed money and repay it 4 years later. As you can see, the more compounding periods you allow on the interest of the loan, the higher it will be. Essentially, period by period, the prior interest is gaining interest on top of it. There is also a positive relationship between the years of the principal and the total future value. The longer it takes to pay back a loan or keep an investment, there will be more cumulative money and interest at the end. You can see this in the graph on the right as it is going up each year. Next, let's look at the future value of annuities. A similar positive relationship applies here, as you can see in the upward sloping graph. But instead, let's say you have 5% and received a regular cash flow or a payment of $30,000 for 3 years. The great thing for you about annuities is that the inflow simply isn't just $30,000 for 3 years. Instead, it's $30,000 with interest, and then that value gains interest each year. The present value of annuities deals with how much money you would need to invest in the beginning for it to grow to a future value. Let's take the same example as before, but instead, let's increase the interest rate to 12%. Because of the negative relationships, you can see the changes reflected in the now downward graph. I would now like to pass your attention to Michael.
Hi, my name is Michael Jury and I'll be presenting the interpretations and analysis of risk and return and risk management. The following data explores the sample and probability of risk and return. The first graph shows the annual return for Beta Limited for the given years, respectively. In 2016, it had the highest annual return being 12%, while in 2018, the lowest at -2%. The following graph underneath indicates the average yearly return, variance, fidelity, coefficient of variation, and the Sharpe ratio. The CV measures the dispersion of return around the mean. Being fairly high means it has a higher relative risk. An investor believes that the returns from investment depend on the state of the economy. The following data at the top right portrays the probability regarding each state and return. The probability of risk return has a high coefficient of variation, meaning there's a high risk. Next, we will see the risk and return portfolio for two shares, A and B, that the investor holds, which is explored in these two graphs. The first graph showcases the expected return and the standard deviation of two shares A and B. The second graph displays the expected return, variance, fidelity, coefficient of variation, and the Sharpe ratio, as well as expected beta for both shares. The coefficient of variation for share A is 132, whilst the coefficient of variation for share B is 252. This means that the investor should invest in share A as it has a lower relative risk. Next, we will conduct a risk assessment of gold manufacturer Beta Limited. Beta Limited goes long and short in a forward contract with an exercise price of $600 per ounce for 2,000 ounces only to be exercised in 6 months. The following graphs assess the risk of both long and short risk management to the gains and losses of two scenarios. In the long risk management, in scenario 1, if the market price of gold after 6 months is $700 per ounce, this results in a gain of $200,000. In scenario 2, if the market price of gold is $400 per ounce, this leads to a loss of $400,000. In the case of short risk management, where in scenario 1, the market price of gold is $700 per ounce, this results in a loss of $200,000. Whilst in scenario 2, the market price of gold is $400 per ounce, therefore reaching a gain of $400,000. Beta Limited is considered a hedger, as a manufacturing company implemented forward contracts to eliminate the risk of price changes on gold. I will now pass your attention to Aries.
Alright, thank you Michael. Hello, my name is Aris Lahmani and I am here to present our findings for Pioneer Limited's 3 different proposals to acquire Beta Limited. They involve a cash, scrip and combined offer. Pioneer's first plan is to propose a cash offer by paying the market price of Beta shares. As shown in the graph over here, the market value of assets will increase by $198,000 from $3.8 million, while the market value of equity only increases by $120,000 from $3 million. Additionally, net income will rise to $620,000 from $400,000. Advantages of this cash proposition is the prevention of any dilution of ownership, rather than it being a split to shareholders. Pioneer's next option is to acquire Beta Limited through a scrip offering by paying the market price of shares. As shown in the graph, our amount of shares outstanding will increase to 72,538 as we acquire 12,538 of Beta Limited shares. Furthermore, the market value of assets after acquisition rises to $4.65 million from 3.8 million, while the market value of equity will increase to 3.772 million from 3 million. The advantage of a scrip proposal is removing the need to pay cash immediately and also being able to use the cash for any future capital investment ventures. The final option is to acquire Beta Limited by proposing a combined offer of 50% scrip and 50% cash by paying the market price of Beta's shares. Displayed on the graph, we can see the number of shares outstanding gained is half of the amount we gained from the previous scrip offer, increasing by 6,269, leaving Pioneer with 66,269 shares outstanding after acquisition. Additionally, the market value of assets will rise by 524,000 to 4.324 million, and the market value of equity will increase to 3.446 million from 3 million. In all three possible proposals, the share price after acquisition will go up to $52, while the market value of debt will only increase to $878,000. The overall aim of Pioneer's acquisition is to increase value by creating synergy. This will help Pioneer sustain growth, increase market power, and unlock potential hidden value. This concludes our insight, interpretations, and analysis of the financial statements we were assigned. Thank you.